Welcome to our podcast. This is Friends on Fire.
I'm Mike. I'm a lifelong devotee of financial independence. I even wrote a book about it.
And I'm Maggie, a newer convert, but just as passionate, especially on the intersection of minimalism and financial independence.
We're one and the same.
We are two like-minded friends who believe that talking about money with your friends and family opens the door to financial well-being.
The Friends on Fire podcast is about dispelling myths, building financial acumen, and sharing your financial independence journey with the people you care about.
This is Friends on Fire. Hey, Maggie.
Hey, Mike.
How's it going?
You know, it's going good. I used to be a lot wealthier than I am today.
Yeah. Same can be said for almost all of us. Yeah, you picked an interesting time to cut off your income, like the worst market pullback in a few years.
I did, yeah. It's like I know my net worth as I'm retiring, and I'm feeling really good about it. And then in like 2 months, my net worth changed by a very drastic amount. You know, like many, many, many years worth of our expenses, right, is what I have, quote, lost. I say quote because, you know, it's not, I never had it. But
well, I'm gonna let you in on a little secret, Maggie.
Yeah.
You should increase the value of your real estate on your net worth chart, and it will likely offset it.
It's funny that you say that. I don't do that. I should. I do it every now and then, like years, you know, but I recently saw a house for sale in our neighborhood. I like to keep an eye on real estate just because I enjoy seeing it. And I saw the listing price of a house. And, you know, you always see a house and you compare it to the quality of yours and the style and everything else. And I was like, oh, wow, ours is like, you know, about the same size, but way nicer, like way more upgraded, way more modern. And I saw the price and I was like, wow, our house in our net worth tracker is like 150 grand off of what this house was implying our house would sell it. So you are correct that I could increase the value of my real estate because the market's doing quite well right now.
Because it is a real number. If you were to decide to move and sell your house, you would sell it for that amount.
Yeah. Or sell a rental property.
Yeah,
I would
exactly.
Sell them
so
at,
it's a real asset.
Healthy profit. Yeah.
And psychologically speaking, if you don't increase the value of your homes as they are realistically valued at in the market, then it creates this weird incentive not to invest in real estate. And real estate in and of itself is a valuable class. It's a good opportunity for your money. So you want to make sure that you're capturing it.
It's an interesting point that you say psychological, because I actually, the reason I don't increase my real estate is because I'm in my net worth tracker is because I'm like, oh, that's just sort of like icing on top, you know, like I like to under promise, over deliver, even with myself. So I actually like to underreport it and know that, oh, actually, if I ever did anything, it's worth even more. But when the market's this down, which is back to our topic today, you're right. That's a way to, you know, make myself feel a little better. I think we're going to make everybody feel a little better today through this discussion about the market.
Unless this is news to you and you haven't looked at the stock market in the past 6 months, then you're going to feel terrible.
In which case, I mean, I'm not a big, like, I don't watch the news. I don't watch and read a ton of news, but if you aren't aware of what's going on in the stock market, I think it might be nice to kind of rethink, perhaps sign up for the daily skim update, which is one of my favorite ways to stay up to date with what's going on in the world. Except those go to my work email. And so I've been a little out of the loop lately. I, for some reason, have not been successful in moving it to my personal email, which is a very simple task that I will now do.
Good. So today is Thursday, May 19th. And yesterday was like a really dramatic day in the market. And this episode is going to air on Monday, the 23rd. So this could all change by Monday, but it kind of reminds me of what we were doing when COVID first started. We were recording multiple episodes a week. They were all very timely and we were responding to stuff. So this is in the same vein.
Yeah, this is a very timely discussion and it's relevant to, you know the dates we're recording and airing and all that. The principles of what we're going to discuss are really helpful, I think, for everyone to understand, because these ups and downs are going to happen over time forever.
Yeah. So we will look at what happened yesterday and use that to start explaining what's been happening the past 6 months. So let me read something that I saw on Yahoo Finance yesterday. And this is the sort of stuff that I read on a daily basis, Maggie, that you like to skim through. I go into detail on it because I'm interested. U.S. stocks sank on Wednesday after a series of disappointing quarterly results from some major retailers weighed on the broader markets. Investors also further digested remarks from the Federal Reserve officials reaffirming their aims of reining in inflation. So two important things in that paragraph. The S&P 500 slid 4% in its worst day since June of 2020. The NASDAQ composite dropped 4.7%, while the Dow fell more than 1,100 points, or 3.6%.
I think the significance there is that's in a single day.
In a single
that's
day.
A daily drop, not that wouldn't be a massive concern over, periods of months.
Yeah, and put this in perspective, if you are in a high yield savings account, you're earning 0.5% interest rate, or if you are invested in bonds, you might be earning 2%. Annually, and these are 4 or 5% drops in a single day. So this is big. So let me read one more paragraph. The moves lower came as some weaker than expected earnings results from major retailers underscored the toll that inflation has been having on corporate profits. Target on Wednesday cut its full-year operating income margin outlook as inputs and transportation costs remain elevated, and estimated it could see an additional $1 billion in transportation costs this year due to rising fuel prices. So this all kicked off because of Target's earnings results. And in that day, Target dropped 25%. And it was like the worst day in 35 years.
And Target's been killing it lately.
Yeah, they've been doing very well. This is a very normal thing that happens in the market. There is some surprise that triggers a broader sell-off because people think about what the implications of that one thing means. Target is a major brick and mortar as well as online retailer in the United States. And so if they post surprise earnings with higher costs, then it also means that Walmart and Amazon and Costco and Sam's Club and all of these groups are going to have similar results in all likelihood. And so everything sells off. And then people might start to panic, and other industries that may or may not be impacted also start to sell off. So this is what causes it. And so if we look back over the 6 months, there has been a Target type event, every week since the year started. And that is what kind of triggers all of these things on a daily basis.
Hey, Mike, the other thing you referenced from that Yahoo Finance article was that investors had some other remarks about the Fed reaffirming their aims of reining in inflation. Can you talk more about that?
So this is something that I think confuses a lot of people, but is very basic in principle and has been part of our economy for, 150 years. I shouldn't say that. I actually don't know when the Fed was started. 100 years, let's call it. And we talked about some of this in episode 33 when COVID first started, where we talked about the economy and how it works.
Hey, Mike, the Federal Reserve was started December 23rd, 1913. I feel like you should know that date. Lock it in. Let's celebrate the birthday of the Federal Reserve. Party. Yeah. Right before Christmas.
So the purpose of the Federal Reserve is to, if I were to summarize this,
reserve the Federals.
Manage inflation and keep the economy healthy. So as we discussed in recent episodes about inflation, episode 144, a small amount of inflation is part of a healthy economy. But if we were to think back to the onset of COVID, we can start to see the pieces coming together. So I'll run through this in an overview. So basically, COVID required an influx of liquidity, so think cash, into the economy because everything ground to a halt. People were not getting sales. They could not pay their employees. The government had to put money into the economy. Okay? So they did this two ways. The Federal Reserve lowered interest rates and then starts pumping cash into the economy. They say, we're going to loan this to you at no cost or very little cost. And people are like, all right, well, if it doesn't cost me anything, then I'll take this essentially free money, no interest rate.
And then they started giving stimulus checks to consumers, including a pretty hefty increased unemployment payment, where there were actually a lot of people, particularly, I even know this from in our industry, Mike, that were making more on unemployment because of the increased rates from the government than they were in their regular jobs. So they didn't want to, they weren't even incentivized to go back to work and to find a job.
Yeah, that's exactly right. So you had banks getting low interest rate loans from the government, which they could turn around and give to people who wanted to buy homes or invest in new businesses. And then you also had individuals getting additional money or, different types of stimulus. And more money and lower rates drives prices up because people are less sensitive to it, right? So, we talked about this on our inflation episode, but, I give you $100 million. You're not going to be too concerned about your $1 ice creams anymore that you're buying for your kids, right? It just won't matter to you. You have so much money that a dollar just doesn't matter. Now, that's an extreme example, but the principle holds. Like if you give people cash or low cost cash, people just become less sensitive to it. So inflation starts, that's what it means. Prices start to go up and then it starts to take over and prices skyrocket. At this point, the Fed needs to jump in and raise interest rates. They need to make that cash more expensive and more scarce. That's how they lower inflation. So they have two responsibilities in order to manage a safe economy. They need to put cash into the market when things are slow. They need to pull it back out and make it more expensive when things are too hot. And that's how they keep inflation in check and the economy healthy.
And hey, Mike, when you're talking about inflation and prices starting to skyrocket, some of the geopolitical things happening too were increasing the price of fuel. And there were those were like other things that were just exacerbating what was already a tough situation.
Yeah, you're right. If we look back to the very beginning of COVID, we can now start to see why things are very volatile in the stock market and why you are hearing a lot about inflation and recessions and why the market's dropping 4 or 5% in a day. The important part about all this, and Maggie, to your point about making people feel good, is that this is kind of normal. This is cyclical and it doesn't feel good, but it happens all the time. And it's important that all investors at all levels are not too emotional about this sort of stuff and make knee-jerk reactions which are going to adversely impact them.
So, Mike, on your point about emotions, I think one of the things that I have tried to do myself and that I think is particularly helpful, and we've even put some posts on social about this over time, is speaking of time, is you might be upset about the decline right now, but you need to zoom out, right? So I love the charts on, you can see these on Yahoo Finance or Google or anywhere when you look up the S&P 500 or any particular stock or index fund. And, you might look at the last 5 days or the last 1 month or year to date and everything's way down, right? And depending on what stock you're looking at or what fund you're looking at, it might be way, way down, like 30% down, like my 401k, 30% down. But it could be, way down. And I think what you have to look at, this is one of my favorite things to do. So Wealthfront, Mike, has some really good views. It's one of the things I love about Wealthfront is just their user experience. Their kind of UI is really nice. And that was the very first investing I started doing was in 2016. And it was with Wealthfront because I didn't know where to begin. And I still love it. And I actually still I buy individual index funds through Fidelity, but I still put money into Wealthfront because I just like the experience. And so a great example of zooming out. So the first fund I ever put money into, they have a really nice view. If I look at 1 year, I'm going to look at the past 3 months. My funds in Wealthfront, which are fairly balanced, are 7.4% down in the last 3 months. They are 11% down in the last 6 months. They're about 6% down this year. But when I look at 3 years, they're 27% up. When I look at 5 years, they're 44% up. And all time, so from 2016 to 2022, which is about 6 years, my funds are up 75%.
That's
right.
Great.
That's what we need to be looking at. Right. And you got to look. So our point is you got to look at this over time. This is a long-term play, and long-term could be 3 years. It doesn't need to be 50 years, right? Could be 3 years, could be 4 years, could be 5 years, could be 10 years, could be 20 years. But I think, to the audience we're talking to here, like people need to have a long-term play. People need to have patience and not get greedy and think, oh, I'm going to buy into something and it's going to, turn into, gold overnight. If you try to time the market and quote, kind of wait out these market declines, you just can't. It's impossible to, right? You're most likely going to miss out on a good bit of growth and only get a modest return, right? So we'll talk about this a lot today, but like you can't try to time the market, right? Especially the people we're talking to here that are not professional investors and, working in the field of finance, right? If you try to beat the market, you will most likely fall victim to a number of dangerous emotional investing pitfalls, of which I've fallen to many, right? Even in this current decline, and I did it around COVID also, when there was a big dip, when quarantine first started and when COVID first broke out. I was like, well, I want to wait for it to get to the bottom, and then I'm going to dump a bunch of money in. And I missed the bottom, because you don't know when the bottom is, right? Next thing you know, one day later, all of a sudden you're like, crap, it's on the rise and I missed the bottom. And we'll talk about some other tips, but you gotta you gotta think about this as a long-term game, and you gotta be patient. And that's really, I think, one of the biggest things that everyone can take away from today's discussion is just, this is a long-term play. Right. Yeah. And again, long-term can mean different things, but it's not, 1 month or 2 months.
And I think most people, when faced with volatility in the market, are going to be paralyzed into inaction. And Maggie, I think this is something that you experienced for a really long time. It was just overwhelming to you. You didn't know what to do. Yeah.
I didn't know where to begin. That's why I didn't invest till I was 36 years old in 2016 was the first time I purchased, other than like some small mutual funds, but I'd never, played in the market until then.
And I think the issue that I've come across personally is that I'm just at times overconfident and think that I know when things have peaked or when the valley has been hit, and I end up making some mistakes or having some bad timing on things just because I try to over gamify what should be a very simple set of decisions.
Yeah. Well, and it's funny, Mike, you'll make some of those kind of big, kind of what I'd say like big ballsy moves. I'm luckily not, I was going to say educated, but I don't know if that's the right word, but maybe that's it.
Don't have balls.
I don't, my balls are not big enough to make some of those moves, but it's almost good for me, right? Because you'll tell me some of the things you're doing, and I'm like, ooh, that's tempting. But I want to believe my own advice, which is dollar cost averaging, putting money into index funds over time, right? Mm-hmm. And there's a lot of times you will give me advice, and I will take them in small way. I won't go in as big as you're going into something, and you've given me some very good advice over the years, and I could pull up some specific funds that you've recommended that are doing quite well even now. And anyways, so yeah, there's both sides of like, you don't want to be paralyzed into no action, and you don't want to be overconfident. You want to know enough and be educated in the space. And by the way, speaking of being educated in the space, if this is like a 201, 301 class to anyone listening right now, we have an episode that we did. It was episode number 68, 5 Simple Steps to Investing. That's a really helpful kind of primer if you've never invested before and you want to know how to get started and where to get started and what sort of funds to buy and what index funds are and all that. That is always helpful. And I'd recommend kind of going back and listening to that.
So let's talk about what you should do during this time. And we'll give some tips. I think the first thing, and this is going to be crazy counterintuitive, but when you are scared that the floor is going to fall out beneath you and the economy is going to collapse, that's probably the best time to start investing or to put more money into the market.
Especially if you're in a good financial position, right? And you can afford, right. You have the cash on hand to do that.
Yeah. And one way to think about it is if you know that eventually over time the market's going to rebound, right? And you are looking at a particular ETF or stock that you like and it has dropped 40%. At some point it's going to go back up, right? In all likelihood, if you have diversified your risk, that ETF is going to go back up. You are now just buying it at a 40% discount. It could drop another 20 points lower, and that is the risk you are taking, but eventually it will go back up.
Yeah. So to give a real example, oh my gosh, I just opened my 401k, Mike, which I really try not to do anymore. It's hit another low point today. I don't think I opened it yesterday, so it was probably there yesterday too. But it's really, I mean, it's many, many years worth of salaries or of living expenses, lower than it was, 6 months ago. But it is all in large cap growth funds, which are high risk, they're aggressive, but I don't need that money. That money I need 30 years from now, right? And so, or 25 years from now. And so to use that as an example, my first reaction to that was like, oh gosh, I'm glad I'm kind of quote diversified in broad-based index funds, because my 401k is all in large cap funds, and they are particularly down right now. Like you said, 30-40% down. But I did just buy some VUG yesterday. It's got a funny name. VUG, which is Vanguard's, what's the name of that fund? It's their company, Vanguard Growth
Large
Index
Cap Growth Fund.
Yeah, it's large cap companies, and it's called their Growth Index Fund. But because you're right, that fund year to date, let's see, year to date it is down. No, is this stat right? 90. Oh, sorry, that was 90 points. $90. I was like 90%.
I was looking at this. I think it's down about 30%.
It's down 28% today, year to date. So this stock is on sale, right? That's the way to think about it. And so to your point, it sounds counterproductive, and it sounds even like more risky. It's like you're walking into the face of a storm or something, or the eye of a storm. I don't think storms have faces.
No, you're absolutely right. Now, there's one important caveat here. Not everything that drops goes back up. Now, we're talking about kind of broad index funds, and VUG specifically is invested in Apple, Microsoft, and large companies like that are focused on growing their business. Those, in all likelihood, are going to go back up. That fund will go back up eventually. Yeah. But if you see some stock that drops 80% over the course of a couple months, it could be going out of business.
Yeah. That is such an important point. We're not talking about individual stocks here. You got to look at the fund. These are huge companies that are Amazon, Google, Microsoft, Tesla. Like, do I believe that they're all going to fall off the face of the earth and not recover through this slump we're in? Like, no, I don't believe that.
So on the flip side of this, the second thing to remember is that once you've had some success, so once you think that the market's unstoppable, like the dot-com boom, or even just a few months ago, like nothing can slow down this economy, I'm going to keep riding this wave. When you feel like you can't lose, you should probably get out at least a little bit. You can capture some of your winnings and wait for the market to dip again. Now, in reality, for most people, the best thing to do is just put your money in, like not worry about it for 30 years, because what we are talking about is timing the market. But like, if you are worried about it, if you are thinking about it, if you are making moves, then you want to be selling when it's high, buying when it's low. And the way you do that is how stressed you feel or how excited you feel about your performance.
Yeah, but just to double click, because you even said the alternative point of view to that, Mike, which is most people should just leave their money in the market and not be trying to time it. You do some of that, Mike, because you are, again, I'd put you in the, higher than average knowledge and experience in this area, right? And you've had decades of experience doing this. I would not put myself in that category. I do not sit there. I've never sold, other than like I once sold some stock because it was when I was trying to pay off my mortgage, and it was an emotional decision, right? But I don't think we're not recommending to the average person that you need to be trimming back your exposure when the market's doing really well. It is a strategy that some people do, but I wouldn't say like right. The average investor.
So Maggie, the most effective thing for people, and you touched on this earlier in the episode, and you called it dollar cost averaging. And this is explaining the concept of just steadily investing over time and letting it sit there. Now, the term comes from the fact that, like, as you are buying things, and if you think of stock market as, these peaks and valleys, you are buying some things when it's high, some things when it's low, and then over time, the dollar cost averages out. And that's how the name gets its term. And this is going to be the most effective way. And by the way, this is what you do. This is what everybody does in their 401k. Every single paycheck, you deposit the same amount of money into the stock market, regardless of what is going on. This is dollar cost averaging at work.
And let me give you two other quick examples of dollar cost averaging at work, because I think 401k is a common one that everyone can get. Another one is like my Wealthfront account. I have an automatic, similar to my 401k, I have an automatic amount that comes out of my checking account every other week. It used to be on payday. I need to adjust things like that now that I don't have a payday. But yeah, so I'm dollar cost averaging that. Doesn't mean I can't dump in some extra money when the market's really down. But I just have an automatic amount, coming out of my bank account. and getting invested. And again, that's akin to the 401k coming out of your paycheck. Another example is and I do this, somewhat frequently, as frequently as anything could be when I've only been investing for 6 years. I like right now when things have been down, things have been trending down for weeks, months. Actually. Yeah, months,
the whole year.
Since the beginning of the year. And I have some cash that I need to invest. I don't want to put a huge lump sum in because I can't time the market. But I can kind of time a period a little bit. And so I've been dollar cost averaging, and some days, every few days when it's like particularly down, I will put a couple $1,000s of the cash I have sitting into an index fund in Fidelity. And that's a version of dollar cost averaging because I've been doing that over the course of a few months now. And I didn't pick the perfect day that it was all the way at the bottom. I don't know if the bottom's already happened. I don't know if it's, trending back up now. I can't time that, which is why I'm dollar cost averaging, right? Mm-hmm. I'm just putting in small amounts over time. And I've had people who are sitting on, sums of money and they want to know, like, should I dump it all in the market? I wouldn't dump it in one day, right? I would do even if you have, if you're sitting on a big sum of money, like 50 grand, I'd put in like 5,000 this week, 5,000 next week. If you happen to see a crazy news day like yesterday where it was down, an extra percent, maybe you put in 10 grand that day, right? But you'd still sort of space out putting that money into the market because unless you just get lucky, which happens, you're not going to pick the day to dump 50 grand into the market that it happens to be at its lowest.
And then with all this stuff, we really recommend not playing with individual stocks because this is as close to gambling as you can get. It can be fun and maybe you will do well. Maybe you'll do really well, but you could also do terribly. And this is why we always talk about index fund investing because you're going to make one purchase and it's going to be spread across 100 or 500 or 1,000 companies. And this is going to limit your risk because one company can very well go out of business and your investment can go to zero. Not with an index fund.
Do you want some fun real life examples of gambling, Mike?
Sure.
So my, index fund, like long, good, steady return over time, even a sector stock that you once recommended in the energy sector, Mike, God, it's up 136% since when I bought. I should have bought more of that one, huh? Another one it's basically an index fund of the S&P 500, but it's up 35% over the total time I've owned it. Here are a few individual picks that I've done that I'd put in the gambling category. Like I read an article about a, Chinese electric car company that was doing some cool things. It is not doing well, down 66%. Another company I read an article about that's doing some interesting things in the medical space, down 79%. This is over the lifetime of me holding it. Mm-hmm. Another one, an early medical marijuana company that got some interesting press like years ago, down 95%. I mean, I've just like donated my money to these causes essentially.
But let me ask you a question. How much total loss do you have on those three?
Oh, yeah, that's a good question. Total loss, $4,500. $4,500.
Yeah, total loss. But your total gains on the other ones is
more
huge.
than makes up. Yeah.
So if you are going to gamble and pick some individual stocks and hope that it goes up 10,000%, which can happen, don't put in more than you are fully prepared to lose.
Yeah. Like I think it's fun to put $1,000 or $2,000 on some of these companies that I'm excited about. But you're right. It's akin to gambling. And clearly I would have been better off going to Vegas with that money.
Yeah.
I mean, 95% is like my money's almost gone.
Yeah, that's right. So let's hit our top 3 takeaways. Number 1, we are in a normal cycle of inflation, tightening fiscal policy, and stock market correction. So don't freak out.
Number 2, as we were just discussing, do not gamble with your money. Invest consistently through ETFs or index funds to lower your risk and just simplify your investing approach overall.
And number 3, when things seem really bad, and they seem really bad right now, resist the urge to make emotional decisions. By the time you've freaked out, chances are that the worst is already over because this news has been slowly seeping into the market.
Yeah, so I hope this discussion has been helpful for people, Mike, because I know there's a lot of chatter on, social media, again, on people asking me about if I'm worried about my retirement timing and the market. And I think, it's a thing that is certainly on many people's minds. And I actually think the less you know about it, the more it's on your mind in some way.
Yeah.
Because it's like the more, like, I feel pretty comfortable because I feel like I know enough to have some trust that, again, this is a long-term play for me. And I also look back, I can zoom back and look at how well I've done over time and not worry about how bad this year's been and look at my long-term gains.
Yeah. Let me just make one more point here. This is why it's important to keep a net worth chart, because if you are doing this for years, you'd be like, oh my God, I've lost $100,000 in the past few months. And then you look back and you're like, actually, I've made $1 million over the past few years. I don't really care about this. I'm just going to move forward.
Well, it is not that you don't care, but you can have perspective, right? And so you're so right about the net worth, because I use that 401k example of like how much I've lost. I remember having conversations with you where I was shocked at how much I had gained over the years since I put it into the large cap growth fund that you recommended. And I almost was like, mathematically, I'm not sure how I've made this much money,
Right.
And so, yes, I'm down, but if I just go back a few years, I'm like, actually, like over time, I'm still, in a very solid position.
Yeah. So thanks everybody for listening. If you've been challenged or inspired by what you've heard, please rate and review the show. You can also subscribe to make sure you never miss an episode.
If you have any thoughts or questions, we always love to hear from you, and you can leave us a voicemail or text us at 404-981-3370, or you can hit us up on Instagram.
All right. Thanks, Maggie.
Thanks, Mike.
Bye.
Bye.